What is going on, YouTube? I'm Mike with Penner Investments, and today I'm going to discuss preparing for a downtrend. Be sure to hit the like button, share this video so others may learn, and subscribe to my channel so you do not miss out on future content. All right, let's jump in. Jerome Powell, the Federal Reserve Chairman, has spoken this past week and talked about the inflation data coming in hotter than expected and the potential for continuing to raise interest rates higher than expected. This is negative news for the stocks, as higher interest rates mean companies have to pay more to borrow, and this reduces their profits. With the CPI data being released this coming Wednesday and the Fed's speech the following week, I believe the market is set for a pullback. So with this information, how can we prepare for this and potentially profit off this? I'm not going to sell any of my long-term holding stocks or panic, as my prediction may be wrong. One thing I have done, I closed out my LEAP option that I purchased on NVIDIA and made a nice couple $1,000 on that. And I'll re-enter this trade after a pullback in the market, since I believe we're going to have a pullback here in the short term. I wanted to take the profit off the table, as there's a decent chance of that evaporating if there is a pullback. My favorite go-to strategy for this type of setup is to buy SPY puts. The SPY is a S&P 500 index fund, and a put is betting that the SPY is going to go lower. So as the market goes lower, the value of my put raises in price. I purchased 5 SPY puts this past Wednesday for $5,535 with a strike price of $390. They expire on June 16th. This is a little over 3 months from now, and I'm hoping to exit these if the market has a knee-jerk reaction to any news and moves lower. A 5 to 10% pullback would be ideal, as this would easily double or triple the price of my SPY puts. It would be the optimal time to close them out for a nice profit. If the market goes higher, I'm completely wrong. I would continue to hold the SPY puts, as they do not expire for over 3 months, for a smaller pullback and accept a small profit or break-even price if I had to. If that falls through, I exit these trades somewhere around May, as I'd still have about another month, and I'd still have a little bit of time value and wouldn't have 100% loss on the put, and then I would just re-enter the trade. That was my plan all along when I entered the trade, but on this past Friday, the market continued its pullback from Thursday. It had a nice little pullback between Thursday and Friday, and I had just over a $2,500 profit on the table. This is just under a 50% profit, as the put options cost me $5,535. I just couldn't leave that on the table. I didn't want to be greedy and try and risk losing the profit for a bigger pullback next week, as I could be wrong on the CPI data and it could come in better than expected. Then the market would move higher, even though I'm expecting a little bit of a downtrend. And then the following week after that, the Fed meeting as well. These are two catalysts that could sink the market or cause a pullback, so that's the optimal time to have these type of trades on. Remember, when the market is going higher, the VIX, which is the volatility index, is lower. That means options are cheaper to buy. When the VIX is higher, we want to sell options, as the premiums are higher. As always, if there's ever anything you'd like me to discuss, please drop a comment in the box below, and thanks for watching and good luck trading.